evening, everyone, and many thanks for coming here on a Friday evening. Thanks, Mr. Ramchandran, for a generous introduction. Thanks a lot, Mr. Shamsuddin, for your kind sort of presence yesterday and today. Really honored. Virgil obviously is among the most trusted sort of channel partner in UAE, and it's our honor to get associated. As Mr. Ramchandran said that 2008 we had some sort of relationship, but it's now properly sort of established in terms of full commitment as we set up our office in Dubai. So the preface is already been said by Mr. Ramchandran in terms of the context where we are. Global economy is perhaps going through another phase of shock as we see, and since probably 2008 we are seeing particularly on the bond in the market quite a bit of damage, if I were to use that word. And as was mentioned again by Mr. Ramchandran, that we are seeing global, Europe is literally in recession. US is inviting sort of in the sense they have to tame the inflation, that's very important. And interest rates have been raised, and that's causing a bit of havoc. While 9 months is a short period, but YTD returns in bond market is perhaps worst 9 months since 1950. I mean, there's a drawdown of almost 18-19%. Bond markets are very large. US bond market is almost $50 trillion. Global markets are almost $130 trillion. So we can imagine the kind of mark-to-market impact it's sort of happening. With that backdrop, I mean, I have a structured presentation. I'll start that, and given the time sort of thing of about 30-35 minutes, we'll focus on the important sort of message, and endeavor would be to just take a longer term view in terms of, as I said, a more 10,000 feet view in terms of globally where things would head post the ongoing chaos. And clearly, I would like to conclude that India is relatively, definitely much better positioned to handle global crisis. Time and again we have seen that because it is a domestic oriented economy. So that would be the sort of thing. I have a structured presentation. I will just go through that, please. 1 second. Same? Is this oh, this is already the presentation. Oh, okay. Sorry. Thanks. Before that, very quick introduction about our progress thus far in terms of the asset management setup in India. We started, we are not immune to sort of global sort of challenges. Our business actually started just before, 6 months before the global crisis in 2008. So we did see the challenge and the assumptions go a bit awry in terms of the first period, because who would have thought Lehman crisis and then what happened post that. And to that extent, the business was built during a bit of crisis. Some of you who would have invested our first product, which was launched in April 2008, a 10 rupee NAV, I remember in 9 months became 5.5. Today it is 85 in 14 years. So it has seen that first year drawdown of 45% during the Lehman crisis, and from there it has moved multifold. As of now, I mean, these are the statistics. We have crossed 1,05,000 crores of AUM in the domestic market. Most of it is active equity funds, and we have 54 lakh folios, number of clients, and the SIP, which is, most of you would know, the monthly book, which comes as a regular commitment on a monthly basis, is almost close to 900 odd crores, which is, we have incremental market share of close to double digit, 9.5–10% in the SIP sort of book. In addition to that, we have the advisory book of almost $600 million, and over time we have last few years the parent company has built in other lines of businesses. Asset management is what we started in 2008. Then we have a capital market business. We have started with the venture capital, and also on the financial services. This is the growth of our our business in terms of AUM. I think it's a derivative. It's the over time. It is the support and the confidence which the channel partners and the investors have shown. I think the end result of that is reflected in the folios or AUM or the growth trend, because the industry is fairly competitive. Most of you would know. It's fairly sort of polarized, competitive. A lot of players, MNCs did, almost all have ventured or have attempted to make a presence in India, be it Goldman, be it JP Morgan, be it BlackRock, be it Fidelity, etc. And we have seen not many sort of successes. So over time, we feel quite satisfied in terms of how the investors have reposed faith. And over time, the business has been built brick by brick, with the commitment of the parent that it's not an easy business. It's not something which can be built in few immediately years. It takes time. It takes time to build performance. No matter what we say about the investment strategy, people will look at the past track record only, and then they will get comfort. Obviously, in terms of establishing relationship with channel partners like Burjeel, but in the home markets, and building distribution, footprint, etc. It takes time. It is long. It takes. You need to be patient in this business. And for us, the journey has been, for the last 14 and a half years, been very, very satisfactory. India, by the way, is a beautiful market in terms of under-penetration of mutual funds in the industry. The total ownership is only 6.5% of the total market size. And there's a huge leg room to grow. First of all, GDP itself would grow. So as we go through the presentation, and as a percentage of GDP, the equity exposure of Indians in the market via direct or a mutual fund is much lower compared to other markets. Whichever way we sort of slice it, the opportunity is very, very significant. I'll come to the presentation in terms of the agenda. We'll try to cover some of the important sort of slides. We'll just look at a couple of most important factors at this point in time, which is interest rate and inflation, both linked, what's happening globally. And second, what is important to India in terms of the second headwind is on the commodity prices, particularly the oil prices. And also would like to sort of look through the lens of medium term, let's say next 2-3 years, how India Inc., various sectors, larger sectors, where they are in the cycle and how they are positioned to handle these two headwinds. And also we'll take a look at, as I said, the longer term thesis, 5-10 year, why India should grow at a particular pace. All of us, I mean, you would have read about many things recently about India being the 5th largest economy, has been going among the fastest sort of growth rate, and will become the 3rd largest by the end of the decade. Why it is so? That would imply a growth of 6.5%. Why in this backdrop, in the longer term, what are the main drivers for growth of the economy? This is just a recap what we sort of initially talked about. Indian markets have been relatively steady current year. If you look at YTD, sort of just a scorecard compared to what's happening globally, including the developed markets, including the US market. Also on currency side has been fairly sort of relatively steady, particularly what's happening to the dollar index, which is extremely sort of strong. It is flight to safety. If US interest rates are north of, two-year paper is north of 4%, why people will go back to, investors will flock back, not take currency risk and go back to the home markets. And we are seeing enough casualty in the market, if I were to use the word. The countries, literally X of China and Japan, everywhere interest rates have been raised across all. The pace, intensity, and the glide path is different. Everyone is raising the interest rate. One of the reasons is what's happening in US and to protect the currency. And we have seen what would have happened if those who have not raised the interest rate. Japan is a classic sort of example. So just, this is the year-to-date change. I think the biggest one single point is just what I mentioned earlier, that the drawdown in the bond markets, that sort of summarizes the big bit of literally last couple of decades, we have not seen this sort of panic post 2007 sort of crisis. And the second part is again unusual increase in the energy prices, etc. That is courtesy the war. No one would have thought war would happen at the start of the year. So this is the backdrop in terms of where we are on the thing. Despite that, this is the latest IMF sort of in a world which is slowing down for the short to medium term. What is the growth rate? So this is the next year growth rate, which is CY23 growth rate. And you can see clearly India is sort of stands out. Coming to the local markets, I think the factors which will lead the interest rate is obviously the most important is what's happening in the global developed markets, particularly US, and it's function of Fed, and to that extent, all of us know, see, the context is closed global market, a lot of money has been put in the system, and that additional money has been further accelerated during the COVID, and that excess money is what was termed as various phases, avoiding the jargons, is basically quantitative easing. And the balance sheets kept on sort of increasing. The reverse is taking place today. So there is two-point fight by the central bank in US. One is to fight the inflation. At the same time, they will have to withdraw money from the system, what has been put in. And by the way, higher interest rates impact if the government balance sheet is high and if the interest rate is to be charged earlier was literally 0.5%, now 4 odd percent, you can imagine the amount of pressure it would have on the fiscal. The second point is on the commodity prices, which drives the inflation in the local market, Indian market, and it is a large bearing on the interest rate. The last point in terms of Indian economy, why interest rates are getting impacted, is the fact that in India we import oil, almost 85% of a requirement, and that put pressure on the currency. And the current account, what it is called, which is more of import minus sort of exports. And these are the three drivers or sort of headwinds in terms of why there is a pressure in the interest rates. As we'll go through it, our assessment is that, first of all, that the inflation in India would peak over the next few months. Inflation is YOY, so it is not a static number. I mean, and the base of commodities was very high in March to June of this year. So as we reach that period, the percentages would look lower. Second is still there is excess liquidity in the Indian government was relatively conservative in putting money in the system post-COVID compared to other sort of countries. And also the fact if the fight of the world or the Fed is to reduce growth by choice by increasing the interest rates so that the growth rate is reduced, so that the inflation is reduced. That's how they would target to fight the inflation. That's the sort of overall framework. If that be achieved, then obviously you would have inflation moderating in India also. And lastly is something which has been work in progress for long, but it is now taking more noises have been made, which is basically Indian GSEC, Indian government paper, is not part of the global bond indices. They are yet to be part of global bond indices. And government is sorting out certain taxation issues in terms of withholding tax, etc. And there is a very high chances that Indian bonds will be part of global bond indices. And there could be allocation, passive allocation, or even active allocation would be considered because they will be part of the benchmark index, particularly when Russia is not a part, has been taken out of the global sort of bond indices. So I think reading all this, in India also interest rates have increased by about 140 basis point. Your 10-year paper, those of you who are tracking it, is increased to about 7.25. Our view is that while near term, obviously, RBI will increase the interest rates. There is a policy due this month, and they will increase, driven by exactly what's the Fed language has been. But I think over time, with the stability of inflation, we would see the interest rate sort of peaking out sometime mid of next year. This is just a recap in terms of how Indian equity markets have done in the past, and we have seen that whenever there is rate has increased, it doesn't necessarily mean that markets have not sort of done well. The second headwind which I was talking about was the sensitivity to oil, and India, it is very, very important that, I mean, the economics of the country is delicate to higher oil prices. Any $10 increase in oil prices, it impacts the government subsidy, which is on the LPG. It impacts the excise collection because they have reduced the excise duties, and it impacts the current account deficit because you have to, for the same amount of volume of the oil, you have to pay higher prices. So it puts pressure on the forex outgo, and obviously it has impact on the inflation, both on consumer inflation as well as wholesale sort of inflation. So I think we are very delicate in terms of oil going to, as you know, at this time the oil went north of $120. Today it is, I mean, as we speak today, it is $85 or so. So it's come down below 100. I think about 100 is sort of tolerable. The threshold, which was 75, 80, has become 95, 100, $15, $20 threshold has increased over the last 2-3 years only because our exports have increased. IT exports has crossed $150 billion, so that's sort of helping it on the current account side. So while we are sensitive to oil, any spike in oil to say 130, 140 clearly put the country in a delicate sort of situation. And what has happened this year is, apart from oil, we have seen some unusual movement in other energy buckets. Coal has moved significantly, gas has moved significantly because of the Russian sort of Russia-Ukraine war. In this backdrop, I think still when we look at data points dispassionately how the country is doing today, and some of the larger data points are showing a lot of stability in compared to the current global sort of headwinds. We look at larger data points like GST collection or e-way bills or electricity consumption, personal credit. I mean, most of them are around 13-14% on a 3-year basis. Last year is not the right base. Year before last is also not the right place because it's been impacted by COVID. But if you look at on a 3-year CAGR basis, or even on absolute number, some of them like GST has touched literally all-time high, close to 150,000 crores per, and we have ultimately even the PMI, which is a technical term used whether the economy is expanding or contracting, north of 50 is expanding. So we've been comfortably above 50 for last sort of few months. So I think why this recovery is sort of happening. This is just the recap of what sort of I said. And before I come to why the recovery is happening, is the recent phenomena that when I said that inflation would peak, one of the reason is that commodity prices have corrected. And they have corrected sharply if you look at last few months, and fall from 52-week high, which is even more sharp. But even if you look at year-to-date movement, particularly on aluminum, it is at 2200. It's fallen by almost from 3800 to 2200. Everything, almost all commodities, including the least corrected is Brent oil, crude oil, but that is also from the peak corrected by almost 35%, which is actually positive for India. Coming to the fact that, as I said, the recent data points are showing a decent sort of traction in the backdrop. And the reason for that is some of the larger verticals, the base is low. So it can only sort of improve. Plus, there are certain reforms taking place in certain section of the sort of economy. So we have favorable base in autos, we have favorable base in housing, we have banking which has been cleaned up, we have consolidation taking place in multiple sort of sectors. And we have the manufacturing theme coming in. I think these are some 5, 6 themes which I would like to sort of very quickly cover in next few slides. Starting with manufacturing, I mean, some of you would have heard the term called PLI, which is production link incentive. So what government is giving is that they directly give 4 to 6% of whatever you produce, and they have put an outlay of 250,000 odd crores in terms of the amount to be put in over the next 5 years. It's been fairly successful. And why, apart from the government push, no businessman will put money just because of government tax incentives? I think there is a case for manufacturing, I would say literally revival after 2 decades. As I said, it's now or never, for 3-4 reasons. First of all, India has a labor cost advantage compared to, let's say, particularly China. Over the last 10 years, the China cost of labor has sort of increased. Second is we have realigned some of the policies, be it production link incentive, be it the income tax rate, which is fairly sort of competitive. Third is the fact that India is perhaps one of the few markets where you can produce in India for the country also and also export. I mean, you would have heard about Apple now been manufacturing for their worldwide shipments iPhone 14 from India 2 weeks after when they started in China. And that speaks a lot in terms of the enthusiasm, and that speaks about the potential of manufacturing. It's also to do with the last point, why manufacturing should move up, is this entire term of China plus one, which is basically most enterprises, they don't want to rely on one single country to, to take goods. And to that extent, the reliance on China, they would like to reduce. And it depends on which other country could sort of, based on have the right to win for that particular opportunity. So there's almost $300 to $400 billion worth of goods which will be de-risked or will be not taken from China. The percentages will reduce, and it's up to whether it is India or any other country to capitalize on that. So there is a tailwind of China plus one. In fact, recently there is a tailwind even of Europe plus one, because the gas prices is prohibitive to manufacture in Europe. But Europe, I would not say it's a structural sort of theme. China plus one is definitely structural sort of tailwind. So all in all, 3-4 points put together, I think manufacturing, which is relatively smaller share in Indian economy at 15%, would increase significantly over the next few years. The second point I was mentioning was the housing cycle. Housing is a very large sector to the economy in terms of there are some 75-80 businesses which are dependent on housing. It is about provide employments to almost 2.5 crore directly, indirectly, include all the businesses, cement, steel, building materials, etc. And what we have seen, there was a downturn since 2013. I mean, some of you would have sort of invested or would have experienced, your relatives or so would have experienced in terms of house prices. You would see literally flattish for last almost a decade in most cities, barring one or two, maybe Hyderabad or so. Most cities we have seen literally no movement in the prices. So the affordability has improved because prices have been fairly benign. Second is interest rates were low. While they have moved up, still they are lower than what they were 5 years back. 5 years back, home loan was around 9.5%, 10%. It went to 6.5%, 7%. Today it is 8.25%. But still it is sort of lower. And income levels have moved up, particularly in the IT sectors. This is just a statistical thing. Why? The point I would like to say is when we look at these global noises, we should see where we are in the cycle. In India, some of the sectors, let's say commercial vehicle, the peak sale 3 years back was 3,40,000. It came down to 1,80,000. So to that extent, it can only sort of move up. In case of two-wheelers, the peak sale was 7 years back at about 2 crore two-wheelers per annum. It came down to as low as 1.4 crore today. So it's already down by 30% in the last few years before the global noises and before the COVID. So multiple things impacted it, and be it GST, the IL&FS crisis, COVID, and supply disruption. So I think the message is the base is low for it to mean revert and sort of improve over the next 2 to 3 years. Hiring activities, again, as picked up by, let's say, Naukri job index, which summarizes that, particularly because of IT outsourcing doing pretty well, has been sort of buoyant. Lastly, the piece which is not doing well, but I think should stabilize over the next 1 year or so, is rural, because we have back-to-back good monsoons. We have migrant jobs. I'm talking about cities. A rural household would have someone working in city, and construction jobs were impacted by COVID. It took a lot of time for normalcy to happen. So that is sort of resuming, is now back to normal. And obviously government is very supportive. We have, after 500 odd days, the mega election, and then you have a lot of state elections. And otherwise also government has been fairly supportive to that. So all put together, I think rural should also stabilize, particularly if the assumption is that inflation would peak in next 6 to 8 months. So I think the last point is the country has seen a lot of challenges, a lot of tough part or the pain of the reforms. We have seen demonetization, we have seen GST, we have seen not reform, but you have the incidents of COVID. All that has put a lot of pressure in the unorganized sector, which is literally half of the economy, or less compliant sort of sector or smaller businesses, and it is advantage those who are tax compliant and strong company, not necessarily big company, but they happen to be larger companies. So strong is getting stronger and weak is getting marginalized. And that is what we are seeing across all sectors. I'm not going to specific of each of the sectors, but we are seeing many of the sectors that over the last 4 or 5 years seen massive consolidation, which is advantage listed companies. So what this mean is why we are better positioned, corporate India Inc. is better positioned to handle the headwind is the debt to equity is lowest in last few years. The banking sector is best of health in last 10 years in terms of the NPAs. And the cycle, as I said, in some of the larger verticals is sort of on an upswing. I was talking about reforms. This chart just gives a snapshot of, I think the country has seen major reforms over the last 5-7 years. Unfortunately, we've never seen a period where you could see all the benefits of reform coming in and you see back to back, let's say at least a period of 2-3 good sort of buoyant year. Just when things were about to improve, we had COVID. And that took two years away. And during COVID also, government has done a lot of reforms. PLI was executed is getting executed during COVID. We have seen some success in 3-4 verticals. We had the labor law reform, which is again work in progress, Gati Shakti related to logistics. And of course, mega reforms of GST, RERA, all that which has happened over the last many years. So where does it bring to in terms of, let me sort of cover the longer term thesis and come back to the markets. And is the fact that what I started, that India is, all of us know now that it's the 5th largest economy and is poised to take over Germany and then Japan in that order over the next, whatever time frame. It's very difficult to pinpoint limit over the next 7-8 years. And the incremental growth is getting much more condensed. The last 2014 to 2024, the growth is looking lower because we said a lot of disruption sort of took place. We had events like demonetization, we have events like once in a century event like COVID, so obviously that's not the right base. And why, the most important point and the message I would like to leave is that why India should grow at a particular rate, let's say 6.5 plus minus 0.5, so 6 to 7% over the next decade or more. I think the pillar of growth is basically there are 2 pillars of growth. One is the beauty of the demographics, and second is the potential in the infrastructure on the investment side. And first part is the demographics, is basically, as most of you know, the median age is 28 years. It is among the youngest. Half of the population is below the age of 28 years. And it will remain, I have a slide next, it would remain 33 years even in 2035. So the demographic dividends, which is working age cohorts to non-working age cohorts, will be favorable for next 3 decades up to almost 2050 or so. So that's the favorable demographics, and the numbers are very, very glaring. If you look at the scale of the population, which is, let's say, millennium, this highest cohort in the world is almost 44 crore people are Indians. And linked to demographics are changes related to reforms in terms of, let's say, urbanization. So we see almost about 2 to 3% of urbanization taking place in a decade. So 0.2, 0.3% urbanization. And the way to grow is significantly higher. We are nowhere close to where the China is. So that helps in terms of the consumption demand. And also, as we come in the subsequent slide, the per capita income has just reached a so-called inflection point, which most economists have put it around $2,000. Once the economy, the per capita income increases $2,000, then what happens? People don't spend so much on the basic needs. They spend more on luxury items or discretionary. I mean, not luxury. Luxury can be different for different cohorts of the population. But the spending on discretionary increases disproportionately. I think it just reached that sort of threshold. And as I was saying, the scale of demographics can also be seen by various data points. The country has to provide 1 crore jobs for next 10 years. And we have to provide almost 18 crore jobs over the next 2 decades. A very, very large number. It is significantly large compared to any other sort of economy. And that also poses a challenge that whether the demographics will give enough dividends or it will become a sort of challenge is depends on the quality of jobs. What would happen is success in manufacturing would help create some jobs, and also I think the advent of gig economy, the shared economy, the platform economy would help move a large section of job from unorganized to organized and also create new jobs. The likes of a Zomato or food tech and many other verticals we are seeing the changes which we are seeing would help the gig or the shared workers was always there in some sense, but now it is getting much more technology savvy, platforms are there for it to sort of capitalize. The second part is the infrastructure. The country is devoid of infrastructure in the sense you're putting, those of you who have seen Mumbai, the amount of work is probably among the highest we have seen in the last few decades. There is a metro happening, there are a couple of large highways projects which are sort of happening. And overall, when we look at the numbers, again, very large number, 110 lakh crores to be spent over a 5-year window. And apart from the investment side, basically investment happens from 3 sources, either corporate spend, government spend, or housing spend. I think the government spend or the public capex is doing very well. Housing sector, as I said, is on the revival. Corporate side is taking a bit of time. And lastly is, all this is fine that you may have demographics, you may have aspiration to invest in infrastructure, but what is important is, are enough reforms taking place to attract capital, because you need capital for growth. And I think a lot of reforms are sort of lubricating that. And that's why, as when given example of Apple or sort of thing, they are coming because they've seen that the ease of doing business is improved. Ease of doing business in this country, in India, is now, is one of the best in last 10 years. It's improved by almost 68 ranks from 140 to 70 odd. And that's why these companies are sort of coming, apart from the inherent sort of potential. And you would have heard success story. I mean, I've talked about some of the hard reforms, but on the digital side, technology side, massive reforms have taken place in terms of how the GEM architecture, which is Jan Dhan account, the Aadhaar, the banking account, and the mobile has been linked, which is helping in giving subsidies, etc. We have seen the benefit of that in the vaccination sort of certificates. And we also seen success of the payment technology mechanism, which is inclusive, the UPI mechanism, which has been fairly sort of successful. So I think all put together does give confidence that the country has a potential to grow at a particular clip. So let's say about 6.5%. You add 5% of inflation, the nominal GDP will be around 11.5%, which is literally doubling in 6.5, 7 years. And that's where, simplistically, it has been in the past, and that is what the potential of the country is. So when we look at the noises in the markets and all, we should get the confidence that we are investing in a company where nominal GDP is sort of, the GDP itself is doubling every sort of 7 odd years, which are on a larger base, on a $3.5 trillion economy. Some of the slides just to substantiate that is that I was talking about when the per capita income, which will touch $4,500 by the end of this decade, and how the consumption pattern, obviously you spend more on recreation, more on healthcare, more on aspiration items. This is the infrastructure pipeline I'm talking about. Just sorry to go to and fro, but coming to the markets, equity markets, I'm sure most of you would have been sort of invested or interested. So the trends which I called out, that the cyclical part of the recovery would help mitigate some of the challenges. I'm not demeaning that the global interest rate is not a, it's a, as Buffett says, interest rate is like gravity. It is significantly important. Interest rate is significantly important for any asset class, not only bonds, any asset class, real estate, equities being the longest duration asset class. So to that extent, there is a upheaval as we speak, but because of the bottom-up revival in some of the sector, in the cyclical rebound from lower base, we see earnings still growing at around 20% pre-COVID to post-COVID on that 4-year window. And markets valuation is around 17, 18 times, which I think is reasonable. It is not very, very cheap. It is not in that bucket, but neither it is expensive when you look from a 3 to 5 year sort of lens. And just on the right-hand side, this chart is interesting. We have seen in the past recession, India clearly earnings growth has been relatively among the best. This is a slide of which is related to equity fund flows. We have seen foreign investors withdrawing from most emerging markets, including India. It's not India specific, it's more to do with, again, the global upheaval that money is going back to US. But we have a very strong SIP sort of flow, domestic mutual fund flow. I talked about our own number is close to 1,000 crore. Monthly number is 12,000 crores. That's a very sticky money, which is providing a very balancing act. The domestic is putting money in the system when FIs are sort of withdrawing. I remember post-global crisis, FI withdrew, there was domestic was totally static. They withdrew about 50,000 odd crores in 5 years, whereas FIs put in about 5 lakh odd crores post the global crisis over the next 5 years. So we have seen very strong sort of maturity and new bucket coming in, which is complementary to the volatility in the FII flows. I talked about the longer term sort of thesis in terms of why the country should go at, on a relative basis, clearly among the best, if not the best. And on an absolute basis also, growing at 11-12% is pretty solid. This is on the stock selection philosophy. I mean, those of you who are interested, we can sort of, I think I've taken a lot of, with the paucity of time, we'll skip that, but we can take it in the Q&A, please. And this is about our sector preferences at this point in time. Again, not everyone would be interested, so I would like to sort of take in. The only point I would like to say that we invest in businesses, which I has mentioned here, which is high growth, with a good return on capital employed, with the character of growth is good, with obviously the management should be very shareholder friendly, and also should have thought leadership to capitalize on the growth opportunity and not overpay for that. So there has to be a margin of safety where value should be higher than the price. And the portfolios are very well diversified so that undue risk is not taken in terms of the construct of the portfolio. Very quickly about summary of our funds over the longer term, 3-year, 5-year, 10-year number. This is the large cap fund is country's third largest fund. And I think in the large cap is the second largest. And it's delivered about 15% CAGR or a 5-year window or so. I mean, this is the quarterly ranking. We have emerging blue chip, which is large and mid cap fund. We have a tax saver, which is just like a normal fund, but it has ATC advantage in terms of the tax benefit. We have a focused product, mid-cap product, and a hybrid fund. And to sort of sum up, I would say that both cyclical recovery, cyclical base and the recovery because of the lower base and structural factors would help not only to grow at a decent clip, but handle the headwinds of the global interest rates. Relatively, as I said, relatively will be better sort of positioned. And the point I was saying is a couple of things which will be a bit of game changer. One is the India's share of manufacturing improving over the next decade. I clearly see a lot of things falling in place which were not there, including reforms and all of that touched upon. And to that extent, it would help revive the manufacturing sector. Inclusion in global bond indices will be a game changer. And of course, the joker in the pack or everything remains on oil. But please see that if the global economy slowdown is happening, then oil prices have to logically correct. So to that extent, that portion is advantage in the near term. So net, I would say that if the time frame is longer term, which is say 3-5 years, not that returns in equities happens in a lumpy manner, right? It can happen in 1 year and not necessarily all years will show positive returns. All of you would know about it. But the longer the time frame, the better the return profile, and it is in sync with the earnings growth. This is the Nifty return. This is the index return. This is not our fund return. If you see as the time frame progresses, the band of high and low returns sort of reduces. A 10-year time frame has a different sort of highest and lower. The drawdown is sort of lower. And over a 25-year, which is a very long period, but we have seen how the index has moved. Sensex was 42 years back, 100, today it is 60,000. So it's moved 600 times in 42 years. Nifty from 1980 is moved to like 18,000. So to that extent, all that may look very dramatic, that 600 times in 42 years, but when you do a CAGR, what it shows is around 14-15% return, which tallies with the nominal GDP growth plus some amount of higher earnings growth of the corporates of the index. And if you are able to construct a portfolio which is slightly better than the nominal GDP growth, this is what it is, which is that we should make a return of around low teens, 13, 14 odd percent. For the investors and the audience here, obviously the question would be currency or so. Over time, now the differential in inflation is reducing, so one can assume say about 3 odd percent sort of currency. But I would say that over a 5-10 year window, getting double-digit dollar returns in India should be very likely for the simple fact which I mentioned, that the economy itself is growing at around 11% in nominal sort of term. And we have seen that in past. After, I think, almost more than a decade or so, all pieces are now falling in place, but for the global sort of environment for growth to sort of accelerate and capitalize on the reforms. This is, I think, the last chart, which is our own experience. I mentioned that the business was started pre-global crisis. We've seen 10 rupee NAV becoming 5.5 1 year. It is 85 now in the large cap fund. We have seen emerging blue chip fund, 10 rupees, now 105 over last 11 years, 12 years. And see the kind of shock the world has seen, including the global crisis. We had the crude issues, we had twice election, we have obviously QE, we had once in a century event of COVID. I mean, all that time, generally I have seen when there is global sort of noise and Indian markets correct because of global noise, that's the better time to invest. Because, as I mentioned in the presentation, that drivers to grow the economy, unlike many other Asian markets, are not dependent on global growth. We are not export dependent economy. In fact, lower import cost helps us. So it's more domestic centric economy. So whenever there is a global correction, we fall in line with others because everyone is selling or so. But that is, most of the time, if you look at in the past, that is an excellent opportunity to go back to equal weight. And when you said valuations are reasonable, it can become cheap because of the volatility, and that is a time to put money. With an assumption, that not to take a very rosy assumption, that you will make double-digit dollar returns, provided the time frame is 3 to 5 years plus. I mean, it can be much longer also because, as I said, the country is poised to grow for next few decades. It's not that it will stop at next, say, after 5 years. That's sort of just closing some of these slides which I would have missed. We also have the funds which I mentioned are funds in the local markets. We are also advisors and we manage a mid-cap fund, which is a dollar product. And that's completed 5 years. It's about more than 1,100-1,200 crores. And as you can see, it has outperformed the sort of benchmark and it's been doing fairly sort of well, and more details can be provided. I think it's there in the leaflet. This is of the, I think this is of the dollar fund, which is 55% return on a 3-year period. And we have seen 3 years because it's very unusual. COVID was there. This is dollar returns and it is significantly more than the benchmark. This is the mid-cap fund. I'm not giving the details. It's there in the leaflet. The emerging blue chip fund, I mean, the mid-cap fund is drawn from our emerging blue chip fund, and that is, as I was mentioning, is completed 12 years, and it's 10x over 12 years. I'm not trying to say that past performance is sort of replicative, but the important message is that the portfolio earnings growth, our endeavor should be more than the market nifty earnings sort of growth. And it capitalizes on market inefficiencies because mid-size, basically when I say mid-caps in India, just to recap some of you, top 100 companies are called large caps, large companies. Next 150 companies are called mid-caps, and the next 250 companies are called small caps. So this fund invests 50% in top 100, which is blue chip, large caps, the HDFC World and Infosys of the HDFC Bank and Infosys types. And also then you have the next 150, which are more. And there are many sectors where right to win is there in large companies. There are many sectors where mid-caps are largest company in that sector. For example, in footwear or in plywood or building materials, many of the sectors, the largest company happens to be in mid-sized companies. So the fund basically capitalizes on both the buckets. This is same about the India mid-cap fund. The large cap fund, which is we positioned is that since it's invest 80% in top 100 companies, those companies, as I said, bluest of blue chip in terms of, I think the portfolio names would be sounding familiar to most of you, I'm sure. And they are bluest of blue chip in terms of sector leadership, proven track record of management, ability to face the headwinds, particularly in environment like this. And time and again we have seen it. These companies are better positioned, the beta is low, and they give very steady sort of stability to the portfolio. So we call it more like a core allocation. If to do it, it should be more in the larger cap sort of segment. Thanks. I think thanks for a patient hearing. I would sort of pause here and probably I exceeded the amount of time, but thanks for coming and happy to take any questions. Thank you.
If you have any questions, please be free to ask. I think there are people around with the mics to help you.
Yes, please. Thank you, Mr. Surana.
Just to clarify, please don't ask stock-specific questions. I don't think the fund manager will answer. Thank you.
Good evening,
You can take it over dinner, stock-specific questions. Yeah, thank you.
Good evening, everyone. Thank you, Mr. Surana. My
Yes,
name is Anil, and thanks for very impressive and informative presentation. My question is basically, as we know here we live, and it is all the currencies in dollars, the revenue. So would like to know like how we can hedge on the currency risk when we invest in India, or whether you have any product or the mutual funds or the investment where we can invest in US dollars or in the dirhams, and it remains in that, and we can withdraw in the same currency. At the same time, it has a very limited risk of forex risk. Thank you very much for this.
So I think, this is the presentation. So do we have a dollar product? The slide which I showed towards the end, which is the mid-cap fund, is dollar denominated. It's a dollar fund. They invest, the dollar gets converted into rupees, they invest in Indian equities. And so to that extent, your investment as well as redemption would be in dollar terms. That said, do we hedge dollars? No, we don't sort of hedge. That we cannot sort of do it because ours is a very simple sort of platform. See, currency hedging can cut both ways. For example, we have seen rupee appreciating significantly X of dollars in other compared to other currencies, whether it is euro, whether it is pound or yen, etc. So right now it is clearly the strength of the dollar, but I think this is the product which I was talking about. These returns are in dollars, they are not in rupees. So we have this fund, it is available here, and Prashant and our colleagues at Burjil can sort of give more data on that. But definitely this fund, and it is invest in mid-cap companies. So I was talking about a large cap fund which invests 80% large cap, 20% mid-cap. In case of mid-cap fund, we invest the reverse. 80% in that next 150 companies, which is not top 100, and 20% is the leeway which the fund manager can use in the large cap. So it gives some stability to the portfolio of the larger cap. It's not totally into, and we don't invest too much down the curve in terms of small or micro cap sort of companies. So these are more stable companies. As I said, some of these companies could be sector leaders in that. I'm not saying Bata is there, but I'm saying just to give a connotation that footwear companies, also these companies of footwear, plywood, many building materials, many cement companies, they happen to be less than 40,000 crore market cap, which is large, but they are classified as mid. So the top company of mid cap is 40,000 crore value. The bottom company of large cap is also that 40,000. 100th company is 40,000 crores. So between 8,000 to 40,000 is the range of sort of this fund which it invests. And it has seen COVID, it has seen last 3 years was from a macro construct, because COVID, while we are taking that as if it is sort of over, when it was happening and all, the line of sight was not clear. Despite that, how the bounce back in earnings have taken place. So I think this fund clearly capitalize on that. Over the longer term, those who have longer term horizon, then mid caps makes a lot of sense. It gives you additional say 1 to 2% higher return, all else being equal. Because the I don't know if I may go in detail, but I may know, if I may ask, how many of you are investing in Indian stocks or stock markets directly? Um, more than half. Yeah. So I'll just say that why all else, what is the beauty or what is the thesis of mid-cap? Is basically you're buying it bit early. You're buying it when the company can become bigger. You're buying it relatively small, young, early, or the sector can get bigger. So what happens is when you're buying something bit early, two things work. Because of the base of profit is less, the percentage growth will be higher, right? Let's say, for example, Infosys IPO happened in mid-90s. Obviously, it was a small cap company when it got formed, right? All companies will be born as small cap only, right? Starting from zero. So if you're buying it early, the percentage growth will be higher, the earnings growth is higher. And generally, when the company get higher size, higher earning stability, larger investors come in, and the P multiple expands. So those of you invested in stock market, what is price? Current market price is earnings into price by earnings. Earnings cancel. So growth of that. So if you're investing in a company which has a higher earnings growth, and we have investing in a company where P multiple will also expand, then you have a multi-bagger information. Because if the profit of the company, let's say, doubles, and at the same time PE multiple moves from say 15 times to 30 times, then the stock price will not double, it will go 4x, something like that. And that's what happens when we see some of the experience of 20, 30 times stocks have happened in our fund also over a 14-year, 10-year period. If you're buying it early, you have compounding effect, which is higher earnings growth and higher. It's basically two horses moving a sort of carriage, and that's why that's the beauty of mid-cap. But you have to be careful in terms of assessment, risk weights, etc. But clearly, I think in India, there is a case to have at least some dosage of mid-cap as well as along with the stability of large cap. And this is the dollar fund at this point in time. Over time, our endeavor will be to launch more products. Yeah. Long answer, but yeah, this is the thing. Thank you.
Can I?
Yes, please.
It's me, Shanavas. Hello.
Yeah.
You can see me?
Yes, please. Yes. Yeah.
Hi. Wonderful performance. It was a very good slides.
Thank
Didn't
you.
bore at all. My question to you is, one of your slides it's been shown that I think it was a 10-year outlook somewhere. IT's weightage has been given 8%. At the same time, the automobiles has been given 66%. So my question to you is, usually IT is an export and automobiles is basically for the internal base. So the flow of money, which is against the dollar, is quite huge when it exports. So how come the weightage of IT has given so low for the next 10 years? And number two, related to IT, the past 1.5 years, the performance is, I think it is negative. So how it is going to impact for the next 10 years?
I didn't sort of understand the question properly, but if the question is that why the weightage of IT in the portfolio is in the index, so index the weightage of IT?
Not the index. Actually, one of your slides, it clearly says that the IT's weightage as given for the outlook is 8%. At the same time, the automobiles is 66%.
Yeah, so automobile that is more about the earnings growth. I'll go through that slides. Basically, it's talking about the earnings growth. So IT never had a big downturn, right? It was, automobile is going through a very low phase and the earnings are increasing because what is, I think probably you're referring to this.
This one.
So it is also, one, the base is low and it is getting distorted by one single company. So this is not our estimate, this is Bloomberg consensus and estimate, so I can talk about it. Is Tata Motors is showing loss in the base or very low profit. So the earnings are looking very high because if the company is moving from very low base and it is showing sort of growth, that's why the percentage growth is looking very, very high. So there is a bit of aberration. If you remove Tata Motors, then this will not be 66%. IT is fairly stable. If there are two sectors which will be impacted by global slowdown, it will be IT and metals. So to that extent, we have to see whether it is a hard landing in terms of the recession or it is a sort of soft landing in the sense like there will be some pain for next 3-6 months, but it will, global IT spend and all will come back. The verdict is yet to be out. It's very chaotic sort of environment in terms of where the interest rates are headed, how long it would be there. What we think is IT had very high sort of uptick period post-COVID because everyone wants to digitalize. So there was front loading of demand. And of course, we had benefit of work from home, so the cost also came down. But it will mean revert. I think IT will go closer to 10%. It may be more showing because of some base effect or some stock sort of thing. But generally, the growth over time in IT should be around 10% plus. Whereas auto is purely because of the lower base. Thanks. Yes, please. Yes, please.
Hi, just a quick one. How long, if at all, do you think India will be decoupled from the global market situations, if at all?
Yeah, no, it's an excellent question, and frankly, no one can sort of say with confidence how things, because global data points are fluid. It will not be decoupled. It can't be, because we are dependent. We may be less dependent on exports, but at the end of the day, it is all interlinked. I gave example of IT, metals. IT doing well has positive effect on housing, autos, demand, etc. So we can't be decoupled to that extent. The point I was saying is, if you look through the chaos, we'll first of all relatively less impacted qualitatively, and we'll bounce back because we'll be less impacted. We'll come back to what sort of we are. That is one point. Second is some of the factors like exports of manufacturing export. It just started. The base is zero, literally zilch. So only way it can either delay the growth or may not happen depending on the execution. But there's no downside to it. Some of the emerging markets and Asian economies, they are very, very dependent on how US would happen in terms of the exports. We are not in that sort of position. So time and again, we have seen whenever there is a global, markets have corrected because of global sort of upheavals. Indian economy, the bounce back has been very, how much it can be impacted, it's a bit difficult to say where the initial interest rates would move up, but all else being equal, if you are to grow at a particular level, a growth rate should clearly come down by at least 1 percentage point.
Thanks.
Because we are assuming that same time next year, even in US, and all inflation will sort of come down. So they would see the pain, and then eventually rates would also peak. Thanks. No more questions. Thanks a lot. I think there is some interesting match also going on, so should probably. Thanks for a patient hearing, and thanks, Virgil.